The Psychology of Investing: How Biases Sabotage Your Wealth by BookSmart Club. Introduction: The Invisible Hand That Moves Your Money. There is a force more powerful than earnings reports, more influential than interest rates, and more persistent than market trends. It operates silently in the background of every investment decision you make, shaping your choices in ways you rarely notice. This force is investor psychology, the collection of mental shortcuts, emotional triggers, and cognitive blind spots that determine whether you build wealth or undermine it. The uncomfortable truth is this: most investment failures are not failures of analysis, but failures of psychology. The market's history is littered with brilliant minds who understood balance sheets but couldn't master their own biases. They knew how to value companies but didn't know how to value their own judgment. They could decode financial statements but couldn't decode their instincts. This book focuses on the 3 psychological traps responsible for more investor losses than all the bear markets combined. 1. Overconfidence bias. The dangerous belief that you know more than you do, leading to reckless decisions. 2. Loss. Aversion. The instinct that makes losses hurt twice as much as gains please, distorting every choice. 3. Herd mentality. The primal urge to follow the crowd, even when the crowd is charging toward a cliff. These are not abstract concepts. They are measurable, predictable forces that cause the average investor to underperform the market by 4 to 6% annually. Dalbar study. Explain why 90% of day traders lose money. FINRA. Turn rational people into panic sellers during crashes and greedy speculators during bubbles. What this book delivers. Unlike most investment books that focus solely on what to do, this one reveals why you don't do it, even when you know better. Through a mix of neuroscience, behavioral economics, and real-world case studies, from the Dutch tulip mania to the GameStop frenzy, you'll discover how your brain sabotages your portfolio without your awareness. Why standard financial advice fails to account for human nature. Practical, evidence-based techniques used by elite investors to counteract these biases. Who this is for. This book is for anyone who has ever held a losing investment too long, waiting for it to come back. Sold a winner too early, only to watch it keep rising. Felt the pull of "this time is different" during market manias. Wondered why they keep making the same mistakes. By the final chapter, you'll possess something far more valuable than stock picks or market timing tricks. A framework for making rational decisions in an irrational financial world. The market will always test your discipline. This book prepares you to pass that test. Turn the page to begin your most profitable journey, the one that happens between your ears. Chapter 1. Overconfidence Bias. The Illusion of Control. Section 1. The Nature of Overconfidence. Overconfidence is not just a minor flaw in human judgment. It is one of the most well-documented and destructive biases in behavioral finance. At its core, overconfidence is the gap between what we truly know and what we believe we know. This gap manifests in 3 specific ways that every investor must understand. 1. Overestimation of knowledge. The human brain is wired to fill gaps in knowledge with assumptions. In investing, this leads to the false belief that reading a few earnings reports or watching financial news equips you with enough insight to outperform the market. A 2018 study by researchers at the University of California found that individual investors who described themselves as very knowledgeable about a stock actually performed worse than those who admitted limited understanding. The more confident investors were, the more they traded, and the more they underperformed. 2. Illusion of control. Many investors behave as if they can influence outcomes that are fundamentally random or dependent on complex, unpredictable systems. For example, day traders often develop superstitions, like only trading at certain times or using specific chart patterns, that create a false sense of control. A classic experiment by psychologist Ellen Langer showed that people demanded higher prices for lottery tickets when they could choose their own numbers despite the odds being identical. This same irrationality appears when investors insist they can time the market, despite decades of evidence showing even professionals fail at this consistently. 3. Self-attribution. Bias. This is the tendency to credit success to skill and blame failure on bad luck. When an investment pays off, the overconfident investor pats themselves on the back for their brilliant analysis. When the same strategy later fails, they blame external factors like market manipulation or unforeseen news. A study of brokerage accounts by Terence Oden revealed that investors routinely misinterpreted their own performance, remembering wins vividly and downplaying losses. This bias creates a dangerous feedback loop where mistakes are never corrected because they're never acknowledged. Section 2. The financial costs of overconfidence. The damage caused by overconfidence isn't theoretical. It's measurable and often severe. Here are the 3 most costly consequences. 1. Hyperactive trading and its drag on returns. Overconfident investors trade far more frequently than is rational. Each trade incurs costs, commissions, bid-ask spreads, and taxes on short-term gains. A landmark study by Brad Barber and Terence Oden analyzed 66,000 households with brokerage accounts. The 20% of investors who traded most actively underperformed the market by 6.5% annually after costs. The reason? More trading meant more fees and more mistakes. The researchers concluded that trading is hazardous to your wealth. 2. The concentration trap. Overconfidence leads to under-diversification. Investors convince themselves they've identified sure things and pour disproportionate capital into a handful of stocks. This violates the most basic rule of risk management: diversification. The collapse of Enron provides a grim case study. Thousands of employees held retirement accounts overloaded with Enron stock, believing in the company's invincibility. When it failed, they lost both their jobs and life savings. 3. Ignoring contrary evidence. The overconfident mind dismisses information that contradicts its beliefs. Before the 2008 financial crisis, many investors ignored warnings about housing market risks because they were certain prices would keep rising. Psychologists call this confirmation bias, the tendency to seek out information that supports our views and ignore what doesn't. A 2020 analysis of investor forums found that during stock bubbles, participants actively mocked those who expressed caution, creating an echo chamber of overconfidence. Section 3. Case studies in overconfidence. 1. Long-term capital management, 1998. This hedge fund employed Nobel Prize-winning economists and believed its mathematical models eliminated risk. They leveraged their positions to extremes, confident they couldn't lose. When Russia defaulted on its debt, an event their models deemed nearly impossible, the fund imploded, requiring a $3.6 billion bailout to prevent global financial contagion. 2. The dot-com bubble, 1999 to 2000. Individual investors poured money into internet companies with no profits, convinced traditional valuation metrics no longer applied. Many quit their jobs to day trade, certain they'd crack the code to easy wealth. When the bubble burst, the Nasdaq lost 78% of its value, and countless overconfident traders were wiped out. 3. The Archegos collapse, 2021. Family office. Archegos Capital took massive, concentrated positions in stocks using risky derivatives. Founder Bill Hwang was so confident in his picks that he ignored basic risk management. When some positions moved against him, the resulting margin calls triggered $30 billion in losses across major banks. Section 4. Overcoming overconfidence. 1. The investment journal method. Keeping a detailed record of every trade, including the rationale beforehand and the outcome afterward, forces objectivity. Over time, patterns emerge. Do your high-conviction picks actually outperform? A 2019 study in the Journal of Financial Planning found investors who maintained journals for at least 6 months reduced their trading frequency by 37%. 2. The checklist defense. Or, inspired by pilots who use pre-flight checklists to avoid errors, investors can create decision-making criteria. For example, have I considered at least 3 risks to this investment? What would have to happen for this thesis to be wrong? Does this position exceed 5% of my portfolio? 3. Automation as a cure. Setting up automatic contributions to index funds removes overconfidence from the equation. Research shows passive investors consistently outperform active ones over the long term, not because they're smarter, but because they're immune to the temptation to outthink the market. Section 5. The humility mindset. The antidote to overconfidence isn't self-doubt, it's disciplined humility. This means accepting that some outcomes are random, even when you're right. Recognizing that even experts are wrong often. Warren Buffett's batting average is about 60%. Defining success as following a rational process, not just making money. A telling study asked professional investors to estimate how often their predictions were correct. The average guess was 72%. When researchers checked, the actual accuracy was 49%, worse than a coin flip. The lesson? The more certain you feel, the more cautious you should be. Chapter 2. Loss aversion, the pain of losing and its costly consequences. Section 1. The psychology of loss. Aversion. Loss aversion is not merely a financial concept. It is deeply rooted in human evolution. Our ancestors who prioritized avoiding threats, like predators, over seeking opportunities, like new food sources, were more likely to survive. This hardwiring explains why, centuries later, the pain of losing $100 feels approximately twice as intense as the pleasure of gaining $100. Nobel laureate Daniel Kahneman and Amos Tversky first quantified this phenomenon in their groundbreaking prospect theory, 1979. Their experiments revealed consistent patterns. 1. The reflection effect. When faced with potential gains, people become risk-averse, preferring a sure $50 over a 50% chance at $100. But when facing losses, they become risk-seeking, opting for a 50% chance to lose $100 rather than a certain $50 loss. This explains why investors hold plummeting stocks, hoping for a rebound. Sell winning positions too early to lock in gains. 2. The endowment effect. People ascribe more value to things they own simply because they own them. In investing, this leads to overvaluing stocks in one's portfolio, resisting selling underperforming assets due to emotional attachment. Section 2. How loss aversion warps decisions. 1. The disposition effect. Documented by Hirsch Sheffrin and Meir Statman, this is the tendency to sell winners too early. Investors cash out gains to avoid the anxiety of watching profits evaporate. Hold losers too long. The hope of breaking even overrides rational assessment. Data. A study of 10,000 brokerage accounts found investors were 50% more likely to sell a stock after a gain than after a loss. 2. Missed opportunities. Loss aversion creates paralysis during market downturns. Historical examples. 2009 financial crisis. Many fled to cash during market lows, missing the subsequent bull run. March 2020 COVID crash. Retail investors pulled $326 billion from equity funds, only to miss the 68% rebound in the S&P 500 over the next year. 3. The sunk cost fallacy. Investors throw good money after bad to justify prior decisions, e.g., averaging down on failing stocks. Case study. Kodak. Long after digital photography disrupted film, retail investors kept buying the stock, unable to accept its obsolescence. Section 3. The Neurobiology of Financial Loss. fMRI studies show monetary losses activate the same brain regions as physical pain, the anterior insula and amygdala. Key findings. The brain reacts to a 1% portfolio loss more strongly than to a 1% gain. Anticipatory anxiety about potential losses can impair judgment before trades even occur. Section 4. Strategies to counteract loss. Aversion. 1. Pre-commitment rules. Stop loss. Orders. Automate exits at predetermined thresholds, e.g., sell if stock falls 15%. Take profit targets. Lock in gains at rational levels, e.g., sell half at 20% appreciation. 2. Reframing techniques. Opportunity cost. Framework. Ask, would I buy this asset today at its current price? If not, sell. Portfolio perspective. Evaluate positions holistically. Does holding this align with my overall strategy? 3. Volatility training. Simulate downturns using historical data to desensitize emotional responses. Example. Review how the S&P 500 dropped 20% plus in 12 months, 10 times since 1950, yet recovered every time. Section 5. Institutional exploitation of loss aversion. Wall Street profits from retail investors' pain avoidance. Active fund managers. Charge high fees by promising loss protection. Structured products. Offer principal protection while hiding fees and complexity. Key takeaway. Recognizing loss aversion is the first step to neutralizing its power. Chapter 3. Herd mentality. The perils of following the crowd. Section 1. The evolutionary roots of herding. Early humans survived by conforming. Dissenting voices were ostracized or killed. Modern investing inherits this bias through 1. Informational cascades. When individuals ignore private knowledge to follow public actions. Example, Bitcoin, 2017. Many bought at $19,000 peak because everyone was doing it, despite Booliji fundamentals. 2. Reputational herding. Professionals mimic peers to avoid career risk. Famous cases. .com analysts maintained buy ratings on worthless stocks to stay employed. Section 2. Market manias and crashes. First, tulip mania, 1637. Bulb prices surged 20 times in months, then collapsed when buyers vanished. Parallel, NFT speculation in 2021. 2. 1929 crash. Shushing boys giving stock tips signaled peak irrationality. Trzeci. GameStop, 2021. Reddit-fueled buying exposed how herd behavior can briefly defy fundamentals. Section 3. Social media amplification. Platforms like Twitter accelerate herding via trending tickers. Create artificial urgency. Echo chambers. Suppress contradictory views. Section 4. Contrarian strategies. 1. The Buffett approach. Be fearful when others are greedy. 2. Sentiment indicators. CBOE put call. Ratio. AAII Bull Bear survey. 3. Checklist for independent thinking. Do I understand this investment beyond headlines? What's the worst-case scenario? Chapter 4. The interplay of biases. How overconfidence, loss aversion, and herd mentality collide. Section 1. The dangerous feedback loop. The three biases we've examined rarely operate in isolation. More often, they interact to create self-reinforcing cycles of poor decision-making. 1. Overconfidence plus herd mentality equals bubble participation. Overconfidence leads investors to believe they've spotted the next big thing. Herd mentality validates this belief as others pile in. Example: the 1999 dot-com bubble saw normally cautious investors pouring life savings into profitless internet stocks, convinced they were missing out on a new economy. 2. Loss aversion plus herd mentality equals panic selling. Initial losses trigger fear, loss aversion. Seeing others sell, herd behavior, amplifies the panic. Example: March 2020 saw the fastest 30% drop in stock market history as both institutions and retail investors stampeded for exits. Section 2. Case Study: the 2008 Financial Crisis. This catastrophe demonstrates all three biases working in concert. First, overconfidence phase, 2004 to 2006. Bankers believed their complex models had eliminated risk. Home buyers were certain housing prices would keep rising. Rating agencies were confident in their AAA ratings. Second, herd behavior phase, 2007. Even skeptics joined the mortgage boom to avoid being left behind. Everyone's doing it mentality suppressed doubts. Third, loss aversion phase, 2008 to 2009. As losses mounted, institutions refused to acknowledge them. The desire to avoid realizing losses delayed necessary write-downs. When panic set in, the herd reversed direction catastrophically. Section 3. The contrarian advantage. Investors who recognize these patterns can exploit them. 1. Identifying extremes. When media narratives become uniformly bullish or bearish. When valuation metrics diverge sharply from historical norms. 2. The discipline of patience. Example: Warren Buffett's "be greedy when others are fearful" approach during crises. Data: investors who bought during peak panic moments, 1987, 2009, 2020, earned extraordinary returns. Section 4. Building cognitive immunity. 1. The checklist manifesto for investors. Predefined criteria for buying and selling. Mandatory cooling-off periods for major decisions. 2. Stress testing. Your portfolio. Regular what-if scenario. Analysis. Maintaining adequate cash reserves to avoid forced selling. 3. The power of doing nothing. Most great investment decisions are about resisting action. Studies show inactive accounts often outperform active ones. Chapter 5. Practical Tools for Bias-Proof Investing. Section 1. Automation as a Defense. 1. Systematic investment plans. Dollar cost averaging removes timing decisions. Example: automatic monthly purchases regardless of market conditions. 2. Algorithmic rebalancing. Forced selling of winners and buying of losers at set intervals. Data: annual rebalancing can add 0.5 to 1% to annual returns. Section 2. Environmental Design. 1. Information diet strategies. Limiting exposure to financial media. Curating a diverse set of analytical perspectives. 2. Account structure tactics. Separate serious money from play money accounts, using time-delayed withdrawal mechanisms. Section 3. The Investor's Journal. A detailed template for recording decisions in real time, analyzing outcomes quarterly, identifying personal bias patterns. Chapter 6. Mastering the Market's Psychology. Section 1. Reading Market Sentiment. 1. Key indicators. Put-call ratios. Short interest data. Mutual fund flows. Second, media analysis. Headline tone tracking. Cover story indicators. Section 2. The psychology of great investors. Profiles of investors who consistently overcame biases. Benjamin Graham's margin of safety. Philip Fisher's scuttlebutt method. John Templeton's pessimism profiling. Section 3. Your personal bias. Audit. A step-by-step guide to 1. Identifying your dominant biases. 2. Creating personalized safeguards. 3. Measuring improvement over time. Conclusion: the lifelong journey. Investing mastery isn't about eliminating emotions. It's about recognizing your psychological patterns, building robust systems, maintaining intellectual humility. The market will always test your psychological resilience. By understanding these biases, you're now equipped to face those tests with greater awareness and better tools.